Hello. Today we are looking at real estate funds. They are investment funds just like their counterparts that invest in securities, so they will have a lot in common. The link to the section on mutual funds is in the description. The only difference between these funds is the direction of investment, and hence the difference. You may have guessed by now, real estate funds invest in real estate. The question may arise that if you can buy property yourself and rent it out, why should you do it through an investment fund? Of course, you have the option of investing in property yourself. If you know how to do it, because you will probably get more out of it because of your expertise than if you were to learn a new area. As a beginner, however, there are a few things you should think about, because it may not be a good idea to take the risk. The real estate market, especially in the private sector which you can access, can generate a good annual return of around 5%. Assuming you're smart, because it's not set in stone. With a badly chosen property or even a tenant, it can easily be negative. If you yourself are sympathetic to the idea of buying a property, renting it out and making a profit from it, but you are a beginner in the field, you might as well invest in a property fund. Let's look at the advantages of this from your point of view. The fund manager's experts will professionally select the property that is expected to yield the highest return. To do this, they have to go through many properties, just as you would, but with a more experienced eye. In the same way as most people do, you would only have the equity if you were looking for investment property, with the rest paid for by a bank loan. The fund manager can also take out a loan to buy a property, but then your future borrowing options are not reduced and you don't have to do anything with the bank. Another advantage is that you do not have to find a tenant and you do not have to deal with them later. You don't have to worry about who you rent it to and for how much, and you don't have to take care of maintenance and renovation. Real estate funds have a well-diversified property portfolio. That means they own several types of property in several locations. As a private individual, this is not something many people are likely to do after them. So their returns do not stand or fall on the success or failure of just one property, so this is the key to safety. To sum up, you can make a profit from renting property without actually having to know how to do it. Besides, the entry limit is much lower. It is not necessary to get started, even with a loan, but you do need to put up the price of an entire property. Real estate funds give you a share of their profits, which is where the capital gains come from. You can ask what a real estate fund's income or growth comes from. It may also get its income from the sale of the property, in which case it will book a similar exchange rate gain to that of securities. They bought it for $100, sold it for $110, then $10 is their gain. This is the smaller part, however, as you cannot rely on selling an office building at a profit every day. Real estate development is more important. This affects the exchange rate through the net asset value. The net asset value shows how much money you would have if you monetized everything. If they improve, modernize or expand a property, its value increases, increasing their total assets. Not to mention that a better equipped place can be rented out for a higher rent. And this brings us to the main source of income for the property fund, which is rent. At the moment, private renting is still in its infancy in Hungary, so fund managers are typically thinking in terms of industrial properties. Office buildings, warehouses and other properties rented by multinationals are their main source of income. All this is done, of course, in full compliance with the law and with security in mind. Security also means knowing how your money is invested in the property fund. The investment options for real estate funds are limited. They can either invest directly in real estate or indirectly, through other real estate funds, in real estate, or they can invest in liquid assets. The liquid asset is also necessary because it is used to redeem units and to maintain real estate, so it is both a necessity for them and a legal requirement. To ensure stability, they are required to have a liquid asset ratio of no less than 15%. Not all property funds invest in the same way. Depending on the type of fund, we can talk about indirect or direct real estate funds. An indirect real estate fund acts as a fund of funds, so it invests in units of other real estate funds. Accordingly, the fund may also be passively managed. There are currently no real estate ETFs in Hungary, but the option of investing in actively managed funds is still open to you. You may have heard before that fund of funds schemes, especially actively managed ones, are expensive, as you pay management fees both here and for the funds purchased by the fund. However, if you look at the 3-year results during the difficult period of COVID, you will see that they have done quite well. The stronger rise around May 2020 and the fall in other funds can be put simply down to 2 things. One is the massive shift to home office, so they could have been more or less affected depending on which properties the fund of funds behind the fund of funds was dealing with. The other explains the rise. During this period of 2020, the forint was at historic lows against either the dollar or the euro. If the fund was denominated in foreign currency, it meant that the net asset value was valued at the daily exchange rate. Thus, if the currency rose, the fund's exchange rate rose, all other things being equal. An indirect property fund is no better or worse than a direct fund, it is just different. On the one hand, because it invests in more funds, it may be a little easier to redeem your units, and on the other hand, it reaches in directions that you might not as a private individual. Now that we've talked about direct real estate funds, let's look at what they can do. A direct real estate fund actually has assets in real estate investments. These can be office buildings, commercial or industrial properties, or even land or apartments. Setting them up and developing them requires specialized knowledge and a lot of startup capital. In the case of a direct real estate fund, the real estate also needs to be actively managed, so we cannot really talk about ETFs here. If you look carefully, they can perform somewhat above indirect real estate funds. This is of course their advantage in normal times. After all, the return differential is largely due to the fact that the fund of funds has already had the management fee of the direct real estate fund built into its fund of funds price. In line with the something for something principle, here are some of the risks that affect real estate funds. Since indirect real estate funds present similar risks to all other investment funds, I will not discuss them here. Instead, let's look at the risks that are associated with real estate and therefore mostly affect direct real estate funds, and only indirectly indirect ones. First in line is liquidity risk. If investors are able to achieve significantly higher returns elsewhere, many may decide to sell their real estate fund units. Since the units can be redeemed at any time by anyone, the fund manager must be able to accommodate this. For a while, the fund manager may suspend the redemption of units. As it may not be willing or able to sell an entire office building, it may not be able to pay investors there and then. The other reason for this decision may be that if everyone tries to get rid of their unit certificates before their value plummets rapidly, they may freeze trading to prevent panic. You should choose this fund if it is acceptable to you, if they do not necessarily meet your request immediately. Second in line is the valuation risk. The asset manager will seek to determine the net asset value as accurately as possible. That is, the amount of capital they would have if they monetized everything. But this is not easy for a property, because you need to be able to say how much you could get for it if you sold it. If similar properties in that area have not changed hands for a long time, the asset manager is forced to use an older exchange rate, which can lead to temporary overvaluation or even undervaluation. By adjusting the exchange rates, the net asset value, and hence the price of the unit, may show significant volatility. The next risk is the risk associated with credit. This is also a form of leverage. The investment fund may also borrow to the extent determined by the fund manager. The borrowing is used for the same purpose as an average investor would use it, to mortgage existing properties in order to buy, build or improve new properties. They can hedge some or all of this risk with forward hedges. Nevertheless, these decisions have their risks. Investors need to be aware of this because, especially in a situation of tight liquidity, the amount of credit drawn down by the fund may increase, leading to significant fluctuations in the exchange rate. Real estate exploitation risk. A real estate fund tries to diversify the properties it owns so that there is neither a geographical nor an industry overweight. Accordingly, it selects different types of properties in different geographical areas. These will vary in terms of the time of construction and the technical equipment. A vacancy during the release period may result in a cash flow shortfall for the fund. This is not a significant risk for a well-diversified portfolio. The release period is healthily spread across different industries and clients with different lease terms. The fund manager will seek to mitigate this risk through active property management and even the use of appropriate financial security built into the lease. Damage resulting from a natural disaster could, however, cause a significant shift in the net asset value of the fund, as determined on a daily basis, and thus in its exchange rate. Let's see the summary. By using a real estate fund, you have the opportunity to benefit from the income from the sale of real estate in a way that keeps your money far more accessible than if you bought the property yourself. It does so in a way that not only approaches, but even exceeds, the return you can achieve. Their many good qualities have stood the test of time, but it should be remembered that the benefits they bring are governed by the law of supply and demand. That is, companies that choose home offices or have gone bankrupt due to quarantine will obviously no longer pay rent for them, which is likely to be reflected in otherwise stable returns.